All right. I did mention right before this went on, I am recording this. And one thing I say at the beginning of all these webinars is watch this again, especially if this option strategy is new to you, or if you're new to options, watch it again, because if you watch it right afterwards, again, it will stick in your long-term memory. If you just watch it once, you learn it, down the road, it is going to fade away, and it's going to be like learning it all over again. How doing, David? So make sure you try and watch this again relatively soon after. I mean, even if you are used to options or even familiar with this strategy, I'm going to be trying to throw in some little nuggets in there that may fly by you the first time. So watch it again and you'll catch those other little nuances, like reading a book twice or watching a movie twice. You start picking up those little nuances. All right. Anyway, my name's Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started trading in college with a psychology degree, which I still claim that part of my degree is been the best suited degree for trading, but started trading with some money I'd earned in high school and started playing around with that, decided to switch my degree over to finance. And after graduating with a finance degree, went up to Chicago, literally just walked onto the floor, not knowing anybody in Chicago, and started asking for a job, handing out my resume, started out as a little runner, and then sold all my stocks, bought my badge, and jumped into the pit and started trading. And have been trading ever since with my own money. And in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products, basically in all market conditions. Other than the early 80s, didn't trade through there, but 80, what was it? Basically about 89, 90 was when I started playing around with stocks. Anyway, take a second to read over this disclaimer. Yes, that is the Stanley Cup. Basically, this says any opinions, news, research, and analysis or other information provided is general commentary and does not constitute investment advice, you guys. Really, it comes down to the fact that I don't know what's in your portfolio. So how could I possibly give you guys investment advice? I also don't know your risk parameters, so I wouldn't even know where to begin with you guys on an individual or as a group. Everybody's completely different. So I can't possibly just throw it out there as a blanket because I don't know risk parameters. I don't know what's in your portfolios, and what I'm doing could be counterintuitive to what you're doing. All right. And please do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. And yes, that is the Stanley Cup from when the Hawks won quite a while ago now, it seems like. Anyway, you can also follow me on Twitter at Wolfman's blog, and you can follow Pro Trader Strategies on Twitter at Pro Trader Strat. I've been throwing out what my earnings trades are. Actually, I'm not giving this necessarily strikes because I don't want to give it out to everybody, but I want to make sure that you guys have access to it that are doing these webinars, watching the daily market commentaries. You know, because in those daily market commentaries, I haven't done my earnings trades that early in the morning. I wait till like the end of the day. So I try and tweet those out for you guys to make sure you guys are on with that. Yeah, and it was the Blackhawks. Yep. Chicago Blackhawks did not do too well this year. All right, so this is the poor man's covered put. Last week we did the poor man's covered call. The poor man's covered call, synthetic long. It's act like a stock with an embedded put, so you have limited risk to the downside or to the upside with the poor man's covered put. And I'll explain all of that, how there's an embedded put in there that you don't really know about unless we kind of talk about it. But this is a great strategy for a directional play to the downside. If you are bearish in an underlying, let's just say, you know, Apple had a big tumble today, but they have earnings coming up. But you were bearish Apple or something along those lines. You're bearish on something. You want to take advantage of it like short selling a stock. But this is a better setup because there's so many other benefits to using options rather than going out there and trying to short a stock like the hedge funds do a lot of times. And I'm not really sure why they, yes, Tesla, I'm already short Tesla. Got my 2-year put on that I already paid for. I don't usually go that far out, but I am pretty bearish on Tesla. All right, so couple of things to go over we need to know. It's a diagonal spread. It's a covered put on leaps. Now, that's what a lot of people will do, and this is long-term anticipated securities. That's the leaps. The traditional way to do this is to go out, over 300 days, basically. I like to cut that in half. I'm usually looking at around 150 days out to set up this poor man's covered put, because I found that, it's easier to pay off the extrinsic value when you're around 150 days or so. If you're out 300 days, it's going to be hard. You're going to have several rolls on your short calls to pay for that extrinsic value. And remember, that's what's going to decay on you. So we don't really want to have any extrinsic value on that long call that we have. So we're going to really be trying to pay that off. I usually will go a little bit shorter, and we'll talk about that when we're setting it up, and as to why. And it's not a calendar spread, because calendar spreads, we would be doing the same strikes. We're going to be going different. All right. It's a bearish strategy, but slightly. I throw that slightly in there because we don't want it to happen like immediately, because we don't get that theta decay out of that short call that we want. Short put that we have in the 35 days to expiration. We want that short put to expire worthless, because that's what's paying for our extrinsic value of the long put that we have in the long duration, which we're going to be looking at like SEP and OC options for the long put. So about 150 days or so. And why use options in place of shorting or borrowing the stock? There's a lot more benefits on the poor man's covered put than on the call, but we're going to reduce our risk, and you don't have to pay the dividend. That's the main thing here, is you don't have to pay a dividend. You reduce capital requirements. If you are going to short a stock, they're going to make you put up a lot of margin for it, and you're going to have to borrow the stock and things of that nature. It gets really messy. But basically, you're going to have to use less capital, and you don't have to pay the borrowing cost, which is reducing all your risk and everything else. Think about it. If you're paying less for something, you're risking less. So your capital you're going to have reduced capital requirements, because you're going to have to pay about a quarter of what it would if you were going to go out there and short this underlying. You also can create a more diversified portfolio of securities, you guys. Think about it. If you are using 25% of what it would normally be, you can do 4 different things, right? If you were going to do one short stock, you could actually do 3 or 4 short stocks. You're able to use your money in different ways, which creates diversification, or a hedge even. All right. And you're going to have a higher probability of success with this particular strategy, because we are going to have that embedded put in there, which is going to increase our probabilities of success, believe it or not. Higher return on capital. Why is it a higher return on capital? Because we use less capital and it pays out the same as the just shorting the stock. Then think about it. You use less capital, but you have the same return. That is going to make your return on the capital you used much higher. And a lot of people like to look at their return on capital. They love, that's people that love playing around with margin, love to make sure that their return on capital is super high. The disadvantages of this, think about it, if we're going out 150 days or even 300 days, you're going to have earnings in this strategy, maybe multiple times. So that is a disadvantage of the poor man's covered put, not a disadvantage to the poor man's covered put versus shorting the stock. Okay. For this, the disadvantages of this trading strategy is that you will have to stay you will have to stay active in earnings. Does that make sense for everybody? And the long put will eventually expire. If you were short the stock, that's not going to expire. You're going to have to continue to pay borrowing costs on that and the dividends things of that nature, but it's not going to expire if you were short the actual stock. But because those long puts eventually expire, that is a disadvantage over the actual shorting of the stock. Forced assignment. Now, if the strategy goes our way, we have a short put in there that could force assignment. Now, I don't ride that short put through. I'm going to roll that out. If it looks like I'm going to be tested on that, I'm probably going to roll that out and down, try and collect about the same credit so it's kind of a wash, and increase my width. The other thing is, just get out of that strategy. If you're riding the short put inside of 10 days to expiration, I'd just either get out of the whole strategy, roll that short put out in time and away from where the underlying's trading. Stay away from that forced assignment, okay? You have the long put where you could force assignment on that guy, but one of the problems with that is you're probably still going to have a little bit of theta left in that long put, and you're kind of giving up money by getting rid of it as well, all right? Unless you get called out on the stock. Well, you could. I mean, you could have forced assignment, but you also have the put where you can force assignment also to create that wash. Did I skip one? I think it forced assignment. So, all right, rules of thumb. My rule is go 6 months to a year out. I'm usually going to be closer in higher than 6 months, but not quite a year. I like to look at around shooting for around 150 days or so. I'll go 90 days, 200 days, but when I start out, I'm starting to look for that 150 day to expiration to start this strategy out, and then I will adjust from there. So these rules of thumb are kind of giving you guys a way to narrow down your search on how to build this out, because it doesn't always work out. It's not going to work out every single time for every single stock, okay, when you're following these rules. But we're shooting for 6 months to a year out. So we're right in that wheelhouse. And we don't want to pay a lot of extrinsic value for that long put. Now think about it. Intrinsic value is what the value of that strike is versus where the underlying is trading. Okay, so if we had a $200 stock, the 210 puts should really be worth $10, but they're going to be trading for like 15, let's say. So that extra $5 is extrinsic value, and that's what we're looking to pay off. All right, so we don't want to pay a lot for extrinsic value. We'd like to try and pay it all off on the first go around, but you may have to roll that short put out, maybe one time to fully pay off that put. All right. All right, we're going to use lower volatility stocks. Now, this isn't implied volatility percent. This is recording link for replay. Yes, it is. We are recording this, you guys. So you will get this sent out to you relatively shortly after. This doesn't mean IV percent. If you've watched any of my other videos or webinars or daily market commentaries, you know I talk a lot about implied volatility percent. That's not what I'm talking about here. This volatility stocks is, like the Teslas and maybe Netflix and stuff like that, where they, generally speaking, have pretty high implied or high volatility. We want to do something that's boring, just trends. We don't want spikes and valleys. We don't want to have to be like looking, okay, well, this is, it's lower lows, lower highs, but they're juking all around. We want this just to be a slow trudge, just a boring stock that slowly sells off. And that's what I'm talking about. Lower volatility stocks like utilities and things of that nature, not necessarily tech stocks, because you will see some big swings in your P&L. Now, if you are a trader that's traded a lot of options, or you've been trading just trading for a long time, that may not necessarily bother you. That would be a higher risk tolerance if you were just picking any stock willy-nilly. All right, and we want to sell near term out of the money strike. Okay, bottom line is we're buying long-term, we're selling short-term. The short-term one that we're selling, we want to try and get inside of about 35 days to expiration. You guys that have watched this for a long time, what we're trying to do is take advantage of this theta decay in the put that we're short. We want that to decay. Anytime you're short an option, you want it to be worthless when it's all said and done, because then you made you collected all of the premium you could out of it. Out here where we're buying our put, see how it starts to flatten out. Now I drew this in here, and this is the at the monies. We're not necessarily doing the at the monies either, and I know that there's arguments to be had on, well, this theta decay profile doesn't match up with an 80 delta option. Okay, I get all of that stuff. What I'm trying to show here is that the further out in time you go, you're seeing less theta decay. It slowly starts flattening out more. Whereas right in here, this theta decay is faster. So we want this to decay faster than these back here. Does that make sense? Can you name some of your favorite stocks, for example, for this strategy? Yeah, I will. I'm going to be pulling up the platform here in a minute, and we'll go over. I'll even throw it out to some of you guys for the ones that you guys would like to short. All right, and make sure there's not a big difference in Vega between months. Now I have a couple of rules here. Volatility, the Vega in the options. What I'm talking about is when we're looking at a option. Oops, it came up on the wrong side. Let me get my platform onto the right side here. If I can pick it up. There we go. All right, so what I'm talking about with volatility, see all these volatility numbers over here? This is what I'm talking about. We don't want a major discrepancy between these volatilities, the one that I'm selling here in May versus the one that I would be buying here in, say, September, because that's right around 150 days. We don't want this to be a big difference. Basically, anything less than a 10% difference is a green light. 10 to 20% difference is a yellow light. And anything over 20% is a red light. Just stay away from it, okay? Yeah, Eric, there might be some questions coming up. I see you're getting ahead of it, but we'll look at those. Just remind me when I call it out, just in case they're all gone. And yes, Arvinash, I probably butchered your name. I'm sorry. You can do weeklies. Absolutely. You could roll them from, like, if you didn't have, if it was inside, let's say this was down to like 20 days to expiration or something like that. And these were about 35, 40 days to expiration. Absolutely. You could. Just make sure there's a lot of volume and open interest in the weeklies as well. And usually when you're given weeklies, there's volume and open interest in there, but just make sure there's a lot of volume and open interest in there so you don't get stuck in it and you have to wait to get out. All right. And then finally, let's get on to, sorry. There we go. Not a big difference in Vega. We got that right. All right. So max profit is the width of the strikes minus the debit paid. Okay. What we're looking for here, the width of the strikes, let's say it's $10 and the debit paid was $7.50, then our max profit is $2.50, right? But something you have to know about this, okay? When we're building this strategy, we do not want to pay more than really like 85% the width of the strike. So in this case, $10 wide, the width of the strikes are $10 wide, we wouldn't want to pay more than $8.50. Anything above anything above that would be a red light. So my rule of thumb here is if you want to shoot for paying for less than 75% the width of the strike. So in that example, very first example, $10 wide, you paid $7.50. That's 75% the width of the strikes, right? That is a green light. Anything less than 75% or less is a green light to go for. If it's 85% to 75%, that's a yellow light. Anything above 85% is a red light. Just walk away from it. There's other strategies out there that I teach that will be more appropriate for this strategy. you want to make sure you're paying the least amount and getting more profit, okay? We want to keep that risk reward better, all right? Trying to put everything together. Max loss is your debit paid. Anytime you're paying a debit, that's your max loss. All right. Your break even is going to be your long put strike, which is that one that's going to be in the money, minus the debit paid. So if we were looking at $10 Y, let's just say $100 put, we paid, or it's a $100 put strike, and we paid $10, then our break even would be at $90, right? That makes sense, everybody? All right, this is when we're going to be pulling up the platform, throw it out to you guys. I want to go through a couple of things. All of my other rules for my other webinars, you guys, when we're talking about picking the right underlying, what's just a little bit review. If we have a stock that we're looking at, let's say it's NVIDIA or Boeing, like Eric's throwing out there, or UAL. If United Airlines is one that I was looking to short, we need to make sure that we can trade it, because we want to make sure that there's a lot of participation in there. So my rule of thumb, any stock under $100, the bid ask here should be 10 cents or less. The difference between the bid ask on the nearest to the expiration, okay? Yeah, this is the nearest monthly to expiration, but it's done. So we want to pick like the nearest one to like 25, 35, 45 days to expiration, somewhere in there. And make sure that the bid ask on these ones that are close to at the money are at least 10 cents wide or less, okay, on a stock under $100. If it's a stock over $100, then we just move the decimal place 3 ticks to the left, and that's how wide it should be. So, for instance, I think what's FedEx is trading definitely over $200. Yeah, $250. So our rule of thumb, move it 3 ticks to the left, 25 cents, right? Well, this is inside of 25 cents. So that would be a stock that we could trade options on, especially if you're a newer trader, because you can get into stocks. I had one earlier today that I saw, really wide bid ask. And when they're really wide, you have to give up too much edge to get in and too much edge to get out. And it doesn't make sense to take on that extra risk, right? Because if there's one guy or two guys in here trading, they don't have to come to you. They're going to wait for you to come to them. If you're in a tight market like this, that means there's multiple people in here fighting over the best market, okay? And they're going to give up edges here and there. That's the kind of market we want to be in. So we only have to give up a couple edges, a couple of pennies or nickels to get filled. Like I go up to a $5.05, and this guy's going to come down to $5.10, and you kind of meet in the middle. You kind of dicker back and forth to get there. It's kind of the idea that we're looking at here. It's not always that case, but you will see that happen. When you better your bid, somebody's going to better an offer, right? The 10 cents bid to ask, is that on the long or the short? It doesn't matter. When we're just looking at this stock, we haven't even really decided, maybe we might have a directional assumption, but I'm trying to figure out, should I be trading options in this underlying? And that's a good way to figure it out right away, okay? So it's between the bid and the ask on a $250 stock. That would be 25 cents because we move it 3 ticks to the left, 25 cents to the bid ask, okay? I wish I had written down that one I saw earlier today, but it was like 30 cents wide on a $50 stock, and that's just way too wide, all right? REGN has wide spreads and not much volume. Yeah, or open interest. Yeah, so I would stay away from something like that in options. As a matter of fact, almost every one of these, Aon might be one of the ones, but I just keep an eye on Aon. But most of these are all going to fit that rule of thumb. But I was looking at earnings or something like that on a particular stock that everybody's heard about, and it was pretty wide. Oh, you know what it was? It was anybody know what Alaskan Airlines is? Offhand, it was Alaskan Airlines. I think it was ALK. Yeah, so 25 cents wide on a $65 stock. Everybody's heard of Alaskan Airlines, or at least most people have, but you can see that there's not a lot of people trading this, so the bid asks are really wide. And earlier today, it was like 30 cents wide on some of these. So just stay away from that when you see something like that. All right. All right. So first one I saw was Boeing. Somebody was bearish Boeing. They've had a nice run. Maybe it is time for them to get a bit of a correction. But, you know, a $200 rally in 1 year is pretty good. They do have earnings coming up here. So I would like to stay away from the one that I'm shorting to not have options or have an earnings here, okay? You know, this is a really great strategy to do right after, let's say, Boeing came out with earnings and it started looking pretty bearish. That would be a good time to put this on also. I just don't like to be short that put or in the long or the poor man's covered call, short that call going into an earnings because I'm reducing some of my profit potential. So best case scenario for me would be sell off all of the intrinsic or the extrinsic value right here, and then maybe have an earnings right in here where I just don't have that call on or that put on, I'm sorry, that short put on during this cycle. And then I would add this put again back here, all right, if I wanted to keep running with it. What do you look for on open interest or in volume? You know, really, I don't even necessarily look at the open interest and volume necessarily anymore because I know that this rule of thumb is pretty solid. 3 ticks to the left, this should be, you know, 34 cents wide, and you can see they're pretty close to 30 cents wide here. So having said that, when they meet that rule, I don't even really need to go and look at the volume and open interest. You can see there's that's a lot of open interest and a lot of volume, especially for a big stock like this. You know, you could look at something like eBay. It's going to have a lot of open interest, quite a bit of volume going on. So I don't even have to necessarily look at that rule. You know, obviously the more volume and open interest there is, the tighter that market's going to be because that means there's so many people in there fighting over trying to make a better market that you get the best market. You know, that's what free markets are all about, right? So I don't even necessarily need to look at the volume and open interest totals. I just know that if these are right here, that there is going to be pretty good volume and open interest. Whereas you look at this one, this is that one that's really wide. You can see there's not a whole lot of volume and open interest going on. As a matter of fact, most of it's been created today or at least gotten out of today. Okay, does that make sense? All right, so let's go back to Boeing. Look at, see if, oh, we had that earnings there. The other one was NVIDIA, I think. Somebody threw out there. NVIDIA. All right, so let's just say we're bearish NVIDIA. That's kind of got that earnings there. We'll just start looking at some things that don't have that have the earnings in them, but let's pretend they don't have them, just to get this show on the road, to get a couple of them. So what did I say? One of my rules of thumb here is going to be, I'm going to start with around the 80 delta option at around 150 days. So that's the September. So I'm going to start looking at the 80 delta. That's where I'm going to start. It's probably not where I'm going to end up. I'm going to start with the 80 delta here, and I'm going to probably start around a 30-ish delta in the one I'm shorting up here. So somewhere in here. So I can see $6.80 I need, or $6.80 is about what I can get. So what I do is I start out here with the 80 delta. Okay. One little floor trader hack is you kind of slide across here and you can see what the extrinsic value of this put is by looking over at the call. All right. It's not perfect, but I'd rather do that than spend, you know, a minute like figuring out the exact extrinsic value for the most part. Because if I were to do this, we can pull up a calculator because I'm not going to be able to do this probably all in my head accurately. I can ballpark it, but that's not going to give you the exact same thing. So let's just look at the 80 delta right here. So what did I say about this strike? The 285 delta, its intrinsic value, what it's really worth, this 285 is really worth basically 285 minus what the underlying is trading, which is 228.71. You know, all of this is monotonous, right? Is that driving you crazy? more than me. So $56 is what the intrinsic value of this option is. That's what it's worth. Okay. Basically, you take 56.29 and subtract it from 285, and you're going to get this price. All right. But having said that, you look across here, $56.29 does not correlate to this price here, right? What's the difference there? Let's just call it $5. Just add $5 in there, $4.50 or something, right? This is a little bit more. It's a bigger stock. It's probably a couple of dollars off, which we are finding with some of the premiums right now, the way that the market's been wanky. But generally speaking, that's what we're looking to pay off here, right? Is that $6. So it's just an easy way to do it. And, you know, I have less to pay off than that, but I'm going to go with the $6, just the easy hack to look over there. I'm going to try and pay off that $6 here. So $6.43. So I come down here and right around that 30 delta. That's about that one right there, right? So, whoops. Of course, I sold the wrong one. Let's do that. We're going to sell that. My other one didn't come up. Okay. Back to the 85. 285. That's this one. So we buy that one. All right. So we're paying $54.09. We know what our break even is. We take this 285 minus the 54, and that gives us 231, right? So 231 is our break even. So our break even is higher than where the underlying is trading because I paid off all the extrinsic value. We did the math. It was about $4 or $5 of extrinsic value, and I paid it off by selling the $6. So I paid off more, which increases my break even to the upside. Right? That's good. Anytime you can sell something higher than where it's trading, that's good, right? Everybody can agree with that. Now what do? We got to figure out whether or not it's a green light, yellow light, or red light. Well, we paid a debit, or we would be paying a debit of $54. So we go $54, divide that by the width of these strikes, which is 70, right? Double check myself, 70, it's a late day on Friday, and 70, make sure I'm doing my math. So 77%. So that's a yellow light, but it's really hard to get, especially in the environment we've seen, a green light, which is below 75%. So this is a yellow light. I would go with that. It's close enough. So that's what I'm talking about. Do that quite often because it doesn't always work out really well. I'll give you an example where it didn't work out. Let's say, for instance, we were wanting to get short the utilities, right? I was saying, hey, we want kind of the utilities are usually pretty boring. So XLU is the ETF for the utilities. So we're going to look at this one. And I see a couple questions popping up. So let me just do this one more real quick just to show you a bad example of how this can go ugly. So let's go and look at the what was I looking at? I think I was looking at the SEP for IWM. Oh, sorry, XLU. I was looking at the SEP. So let's look at the SEP. So we go up here. We start out at around the 80 put, right? You can kind of look over here to get a glimpse at what we're going to be trying to do here with our strikes. And so we're going to start out the 82, which is the 54s right here. So I got to try and pay off about 57 of extrinsic value. I'm not even going to bother going through the math. I'm just going to do it. And then try and sell the 49 puts. I'm not going to be able to pay for all of it, but we'll go with it. It's close. Now I just know I have to, when this decays, I'm going to have to roll it out one more month. Okay. So we have a $5 wide spread, right? $5 wide spread, $4.17. Let's just go with that. Divided by a $5 wide spread, 83. So that's a little bit high, okay? and it was actually a little bit worse earlier today. I think I had it at 426 earlier today. So you could see something like if this was trading $4.26 when it was trading during the day, and I divide that 85, so it's even worse. Wait, that's not a $5 wide. Did I do that right? $4.26 divided by 5. Yeah, okay. So it's getting a little high there, and we want to stay away from that. All right, another example of a good one. This is a really good example, and you would have to be short, or so you can obviously do this in ETFs as well. My rule of thumb with this, I want lower volatility stocks, but the implied volatility percent seems to work out the best for this whole strategy when it's somewhere between 30 and 50 IV percent, and when they're very close in relationship to one another, okay, on the implied volatility, and this one does, so we're good with that. So XLU, we want to look at it. That's a little bit wide. Really good example is XLK. So let's look at XLK and get rid of that one. Sorry. Delete. So this is a good one. XLK, or at least it was earlier today. I want to look at for the 80 delta. So this is around the 80 delta, right? I got to pay off around these spreads got really wide all of a sudden. On a Friday, they will be wider than normal and may not meet my rule on a Friday after the close, just as an FYI. So I'm looking at the 73 puts. I'm going to buy at around the 80 delta. I got to go up here and pay for that extrinsic value. We're just going to do my little floor trader hack, go over there. I'm going to say about 70 some odd cents. Go back here and look at around that 30. I want to start out around the 36 delta, but it looks like I can go down just about to here. Let's just try that one just to see how it works out. Sell that one. All right, so let's look at our rule of thumb. Some of you guys can probably do the math very easily. We got a $10 wide, right? So we're paying $6.87, 6.87 divided by 10, and I hope you guys are doing this math in your head. 67% or 68.7%. All right. So that is a green light. So it will happen where you can get it below 75. It's a rarer occurrence, I will agree, but that means it's a green light. That's a go, right? If you're up there in the yellow, I'd still probably go with it. If it's red, just walk away. There's other strategies. All right. With ETFs, you don't have to worry about earnings. You're absolutely right, and that is the beauty in it. You get the whole sector. So, if you're bearish on tech, this would be something to throw in there. Do you guys have any other questions real quick before I start going on to the next ones? I want to make sure you guys are understanding this. So we start out with the 80 delta, right? We've already gone through, we moved the decimal 3 ticks to the left, or 10 cents to the bid ask. These are really wide, you guys, and you're going to say XLK is really wide right now on the days to expiration. It's because it's a Friday. Nobody leaves orders in, and I hope you guys don't either leave orders in on a Friday over the weekend. Everybody pulls them because anything can happen, and they don't want to have to worry about it if something does. So they pull all their orders, and these get really wide, but XLK, generally speaking, is pretty tight. And I vetted this one during open market outcry or open market trading, and it was right there at 681, as a matter of fact, a bit lower. So it was even better earlier. Okay, but you can get these to where they get like super wide, and anything over, like I said, below 75% the width of the strikes, green light, 75 to 85, yellow light, above 85 is a green light. And one of the things that I want to re-mention when we were talking about the difference in these volatility numbers between, let's say, the May and the September. When I was talking about that volatility differential, we want this to be less than 10%. Believe me, it will get out of whack sometimes. But you don't have to worry about it. It's probably full on green light on this strategy if the volatility in the front month that we're selling is higher than the one that we are buying. And that's called being in backwardation. And if you've heard of backwardation and Contango and your head just exploded, oh God, he's not going to talk about that. One thing to make that whole thing easy is when they're talking or you're talking about backwardation. The easiest way to remember backwardation versus Contango. Backwardation is backward down. The back is further down than the front. Okay, backwardation. Contango is the back is higher than the front. So just remember that little hint. Backward down is backwardation. So if volatility on this underlying is in backwardation and there's no earnings happening there, or no real event going on, it's just volatility driving it, then that is a perfect scenario, because then we're paying less for volatility, because volatility pumps up the premiums, right? Anytime you have volatility, these premiums get jacked up. So if this volatility is lower than this volatility, that means I'm paying less for this strike or this option expiration cycle than I am where I'm selling it, because I'm selling it for a higher implied volatility. So that's a great scenario. If you look over here and see volatility is jacked up a lot higher than the front, that's when you're going to get this really serious discrepancy. Okay, and vice versa. If this volatility is much higher, that means you're paying more for the volatility than you're able to sell, and that's going to drag this up and make it closer to like that 85, 90%. And you will see when you're trying to build these strategies, like you're like 85% the width of the strikes, like who would do that? You know, if you don't like do the math on it, you will see that some of these will get jacked up closer to around, sometimes you'll even see 90%. I've even seen it almost the full width of the spread. So just walk away. Just walk away. All right. You guys want to see one more example? I gave you pretty much my best ones, but this was a pretty good one. Like Honeywell, HON, came out with better than expected earnings. They jacked up early this morning. If you watch the daily market commentaries, you know I traded this for the earnings. Jacked up, and then the market kind of came out. To me, this looks like a pretty bearish signal, doesn't it? We're continuing to see pretty much lower highs, lower lows for the most part, pretty downward bearish pattern. This is saying it's green, the MACD. But if we think this is going to roll over, this could be an opportunity. We just had the earnings, so we don't have to worry about earnings for quite some time. So we can go in here and try this one out. So let's look at around. We're going to start it around the 80 delta, right? So about the 170. I don't know if I'll be able to pay a whole or get a whole $1.70 for the May contract here. It'd be pretty close. I'd have to go very close, right, to get that full $1.70. So I'm going to go a little bit higher, so I have a little less extrinsic value. So let's go with the 92 cents for extrinsic value. I got to pay off 92 cents. Let's just try this one. See what happens. It's around 20, right? I'm paying around $20, let's say. This is $25 wide, so it's going to be around 80, right? If we take the 19.86 divided by 25, 79. All right, so it's a little high, but what happens when we decide to move this out? Like I said, we're going to start out with those strikes, try and pay for that, but let's try and move it out a little bit further and go to the 140 put just to see and play around with this, because you will see some instances. All right, I did that right. All right, that it will work out a little bit better. So if we have, we're paying $20.55 for this strategy. We go $20.55, 0.55, divided that by 30, which is the width of these, right? 40 to 70 is 30, equals 68.85. Another good example. So don't always just go with the one that you originally started with. You can kind of go out a little bit further. One thing with this one is we probably aren't necessarily going to be above where the underlying is trading, because we can figure out where our break even is, right? You take the 170, which is where my strike is, subtract the $20.55 minus the $20.55. Some of you guys already did this in your head. 149.55. So we're selling it almost $1 lower. And that's why, because I didn't pay for all that extrinsic value. That extrinsic value shows up in my break even. So that's another reason why I like to say, hey, make sure you're paying for that extrinsic value. Otherwise, I'm going to have to roll this one out again, probably to one of these options when this decays, to pay for all that extrinsic value. One thing with this though, I have a higher profit potential, right? But I do have a little bit more risk because I need another dollar down move in order to get to my break even, which isn't necessarily out of the realm of possibility. You can see that it was already trading at that level earlier today, right? So it traded in that range. So that's not out of the realm of possibility for this. On the short side, should we close, or shouldn't we be close to at the money for the maximum return? For the short side, the one thing with you go to the short side, you're obviously going to have a higher probability of success because that closer to the at the money strike is higher probability, right? But you're also, it's going to be harder to get your money out because it's going to make that move faster, right? We don't want it to happen right away. Now, maybe if you thought it was going to bounce a little bit or something like that, you could go a little bit closer. I like to get a little further away and increase my width of my spread so that I can make a little bit more money. Now, when do we get out on this? We get out when you're going to kind of play around with this. I like to get out when my short strike is breached. All right, or when my short put strike is breached. So when the market goes down and tags my short put, usually that's where I'm going to get out for whatever profit I can get for. All right, that's my rule. Now you might have Fibonacci levels or something like that. You might throw up fibs on here. Do I have the fibs up? It's not going to give it to me. I'm doing this dirty. I'm not even paying attention if I'm on the thing or not. But let's just say you thought, all right, well, I think it's going to come down here and test this. That's where it's looking to go to me. It could go, pick your strikes around there to try and go for that. But my rule of thumb is when my short strike is breached, that's when I'm going to cover my strategy. I'm just going to get out. What's your favorite go-to strategy year round? The poor man's covered call or the poor man's covered put? Listen, I'm a contrarian, so I would probably lean towards the poor man's covered put because I'm always looking for that correction. So I would probably use the poor man's covered put more often than I do the poor man's covered call. But I'm usually playing things for corrections into the downside. So for me, Honeywell is probably going to be that strategy I put on Monday for the poor man's covered put. Because usually what you guys, when I'm doing these webinars, I'm doing this for me too, right? I'm going through all these strategies. I'm vetting all of these and trying to find the best one to short. And to me, this Honeywell with with only 68% the width of the strikes that I'm paying for, that's good. It's close to 50-50 as you're going to get with this strategy. And the other thing is we've got the chart set up here. So I think, somebody could say, hey, well, it looks like it's settled above that Fibonacci level. That's going to act as support. Well, that doji to me is kind of a little bit more telling than the Fibonacci at this point, and it might even be lower because I don't think I even got the right level. But I'm still looking for it to roll over like that. Do you look for skew to decide the call or the put? I will sometimes. I will usually when the strategy is not working out. That's usually when I kind of go to that. There is going to be usually skew to the put side, which benefits this strategy a little bit more because you're going to be able to get a little further out and still pay for that extrinsic value. But I'm not really, I'm not really I don't know what the right word is. That's not going to be the make or break for me, is the best way I can come up with it. Does that make sense? Faster to fall, climbing back up takes longer. And that's true. And so sometimes, that's why the poor man's covered call is pretty good, because a lot of times you just see these things trudge up, and that's what you want to do, because then you can kind of roll your call out a bunch. And, sometimes you can get to the point where you've paid off the entire value of that put and you have it on for free. I did a couple of trades in that Tesla where I've got a 2-year put on in Tesla, and I paid off that put completely by selling options against it. So, you can do that. It's possible to have a free put on for 2 years. So that's another reason why it's really important to watch these daily market commentaries, you guys, because I go through all this. Every month I was talking about that and paying off that. So watch those daily market commentaries, because I do all these strategies every day and go through them, how I'm being mechanical when they're not working, when they're, a thorn in my side, and what I'm doing to try and increase my probabilities of success. What about just doing both a poor man's covered call and a poor man's covered put to have like on an iron condor? You aren't going to make any money on that. It's just, I can't see how you're going to make money on that unless it just never moved and you were able to collect all these premiums on the calls and the puts that you were shorting against those other ones. I wouldn't do it. For this one, I would go with the directional assumption. Otherwise, why not just do the iron condor? The probabilities are probably going to end up being better than doing a poor man's covered call and a poor man's covered put. And you're going to have a lot less risk, because think about how much premium we're paying for these deep in the money calls and puts, right? And it could go in either direction and you're going to lose a lot of money. So I would stay away from that whole thing. But I have never tested it. So it just, to me, at first blush, just thinking about it right now, it just throws up a red flag for me. That makes sense? But you could try it in like a paper trading account if you want it. All right, that's about it, you guys. I mean, it's a relatively simple strategy, but it is one you should know, especially if you've ever wanted to short an underlying and really wanted to get short it. So it's a great strategy for a real directional play. Can you explain how you use the TPO profile and the monkey bars? I actually have a webinar on it. I don't have enough time to go through how to trade those, but I do have a webinar and a bunch of different shorter videos on how to trade market profile. And as a matter of fact, you could almost just watch, like, again, the daily market commentaries, because, I go through all my charts and the daily market commentaries, and, I do the market profile on a daily segment, and I do the market profile on the full on, because I trade that a lot. And I love it when the market profile lines up with Fibonacci, and, I talk about that stuff too. So, but I don't have enough time to go into all that with a couple minutes we have here. Do you have a subscription service for the poor man's covered call and or the poor man's covered put? I do have a subscription service. I don't know that we don't necessarily have that for just those two, but reach out to us at 310-598-6677 or trading@protraderstrategies.com, and they'll set you up with the right one that gets it. Does that make sense? And Wally, did you get that? I mean, with the market profile, there's books written about how to trade that. There's no way I can get that done. Anyway, this is our deal for the day, you guys, for all you guys that attended this. So make sure you take advantage of it. It's in the chat window there. It's got this link right here. If you're watching this on tape delay, like I see HH took off a little bit early. Basically floor trader hacks for options. You know, just like that that little nugget I gave you guys on how to figure out the extrinsic value, stuff like that. There's 9 floor trader hacks. It's going to make things make a lot more sense to you. These little floor trader hacks, like just that. I'm sure light bulbs went off on people's heads when I showed you. You looked straight across. Doesn't that make sense? Out of the money options are all extrinsic value. In the money options have part intrinsic value, which is what their value is, and extrinsic value, which is that theta decay. Basically, easy to look right across to the other one. Of course, you know, big $1,000 stocks, it doesn't always work out. It's pretty close though for government work, so that I don't have to go through all that math on a daily basis. Because think about it, if I went through 20 stocks having to figure out the extrinsic value on every one of these stocks, it would have taken me forever. So in less time, I just look across, boom, boom, boom. I know what I'm paying for. Okay. All right, but take advantage of this, you guys. All kinds of different webinars in here that you can basically go through and click on them, check them off on the box that you've done those. All right, shortcuts all around the board. This is a great strategy or a great package for all of these options. I'm telling you, it is well worth it. It is a little bit more expensive than most of our little deals, but you know, you aren't going to find this anywhere for sure. All right, so take advantage of that. What do you guys say? I mean, you guys have obviously done your homework. You guys are doing what it takes to get ahead in trading by learning, and that's I applaud you for that. I even still continue to learn. But if you enjoyed my instruction, especially if you guys are one of my regulars, you guys should take advantage of this course. And at the end of the day, all we can do is learn and get better at what we're doing. And the best way to become a better trader is to constantly learn, which is clearly, like I said, what you guys are doing. But wouldn't you guys say learning the poor man's covered put online wasn't probably as informative as what I've taught? Like, you can go on there, they're going to tell you to go buy an in the money leap and then go and sell an out of the money near duration, right? They're not going to tell you how many days to expiration and why you need to do that. They're not going to tell you the volatility, what you need to look for, and those rules of thumbs, the red light, green light, yellow light stuff, all right? Or red light, red light, yellow light, green light. Those are little things that I teach that I think are very valuable. And this here with floor trader hacks is huge. So if you guys are using the right tools in the right situation, you guys are going to be more productive state of mind, be able to put on more strategy, which creates more opportunities and ultimately builds confidence. All right. So we're offering this, guys, for you guys today. Sign up for it. Easy to click on that. And if you have any questions, you can reach out to us 310-598-6677 or trading@protraderstrategies.com. All right. Great. Appreciate it, you guys. Make sure you click on that link and watch my daily market commentaries. Seriously. In later webinars, I'll be drilling down on option components, how I trade, trades I find, where I find them appropriate. This is also that link. Obviously not a hot link. It looks like it, but you'll just have to pause, punch this in if you're watching it on tape delay. And I want to thank you guys all for watching. Again, you can contact us at 310-598-6677 or email us at trading@protraderstrategies.com. And if you guys are watching those daily market commentaries, let me know what you guys think, and give me a like and comments on these webinars as well. All right, that's it, guys. That's all I got. If you can't take that, take it easy. Thanks, Eric. Appreciate the kind words. Take care, everybody. Have a good one.